Cost of capital, more specifically weighted average cost of capital. What is it? How is it used? Where is it used? And how is it calculated? That's what we're going to talk about today, and welcome to My Finance Teacher. First, let's back up a little bit and talk about net present value, which is a calculation that helps to estimate today's value, present value, hence the name, of some future expected cash inflows. When we talk about future versus the present, we need to take into account the time value of money. And we do take into account the time value of money by using some sort of a discount rate. We discount the future cash flows when we try to convert them into present value, into today's value. Because today, the value of money now is a little bit heavier than it is in the future. Hence, we discount future cash flows to some extent. To give you an example to illustrate this point, consider a choice between receiving $1,000 right now or receiving the same amount, $1,000, next year. What would you choose? I think most would choose to receive $1,000 right now. Hence, I say it has more weight. It's a bit heavier. It's a bit heftier. It's a bit more rewarding to receive $1,000 right now rather than $1,000 1 year later. And another way to look at it is if you receive $1,000 right now and invest it, let's say you earn 5% during a year. By next year, you'll have more than that $1,000. You'll have that original $1,000 plus the yield of, in this case, 5%. Moving on to how do we calculate the net present value, which will help us to actually move on to the cost of capital, today's topic. The formula for net present value is the sum of all present and future cash flows discounted using some sort of a discount rate. So NPV here, of course, is net present value, CF is cash flow, T is the time of the cash flow, perhaps cash flow right now, T0, is the price that I need to pay to obtain the right for future cash flows through, for example, buying a bond or buying a stock that will pay future dividends. In this case, the current cash flow is going to be negative as I'm paying the price out of my pocket, which is a cash outflow for me. And all future cash flows are going to be divided by 1 plus this discount rate into the power of that T. And what brings us to our topic today, the weighted average cost of capital, is there are a few ways of looking at this discount rate. One of the ways of looking at the discount rate is plugging your cost of capital into this formula. So that's where the cost of capital, or the weighted average cost of capital, fits into the rest of finance, especially in relation to net present value. So finally, coming to the cost of capital. The capital can be obtained from several sources. You can simply go to the bank and borrow as an entrepreneur. In this example, we're going through these three sources of capital. An entrepreneur, a company, might issue bonds and sell them, hence raise capital. A company might issue preferred shares, preferred stocks, and sell them, hence issue capital, or do the same with common shares. Bonds, of course, have the highest claim on the company assets in case of liquidation. Preferred stocks, preferred shares, have a relatively high claim on assets in case of liquidation. They go after bonds and before the regular shareholders, the holders of common shares. And after paying all of the debts and paying back the holders of preferred stocks, if there is anything left in case of a liquidation, the common shareholders get their turn at the claim on the company's assets. So what we're going to do is we're going to see how do we calculate the cost of capital from each of these three sources, and then we combine those into the weighted average cost of capital. So let's start with bonds, which is basically debt. So we'll look at cost of debt. And because interest, the repayment of that debt, is actually tax deductible, the real cost of debt is a little bit smaller than it seems at first glance. At first glance, the interest that the company pays can be calculated, and we'll have a look at the way to calculate that in a minute. But in reality, the actual cost of debt over here is a little bit less than that because the interest expense is tax deductible. Now let's calculate the cost of capital before tax. That's basically the yield, that's basically the return that the company pays to the bondholders. So let's have a look at this example. Let's say we have newly issued bonds which are expiring, which are maturing in 4 years. And the face value of the bonds is, let's say, $1,000. Let's say the company for some reason chose a coupon rate of 6% per year. So 6% of the face value is paid as coupon payments every year, but the payments are made quarterly. And depending on the ongoing market interest rates, if the coupon rate is more attractive than market alternatives, perhaps the market participants will be more interested in the company's bonds rather than some other alternatives. Hence the price is in this case a little bit higher than the face value, and the price is $1,100. To calculate the actual yield per year that the company will generate for bondholders, we can use a simple formula in Excel. Just hit equals rate and open the brackets. You see all the hints that the computer gives you. The NPR is the number of periods. The computer doesn't understand if the things are quarterly, monthly, annual, or whatever. So we give the computer the smallest periods, which are quarters over here. And there are 16 quarters in a 4-year time to maturity. So I enter 16 here. The payment per period is a quarter of 6% of 1,000. 6% of 1,000 is $60, and a quarter of that is $15. So for PMT, I can just enter 60 divided by 4. PV stands for present value, the value that you have to give away today to obtain the right for future cash flow. In this case, it's the price. Negative 1,100 is the negative cash outflow to obtain future cash flows. And FV is the face value of 1,000. This will give you the rate per period, but again, the computer doesn't know anything about the periods. Is it quarterly or monthly? We have to manually adjust to a rate per annum, to a rate per year. In this case, we'll multiply by 4 because this is a quarterly period. Then hit enter, and the annual rate is rounded to around 3%. If you want to see more details, just use this button to see that actually the before tax cost of capital is 3.32%. So the yield that company provides to the bondholders is this much. In reality, though, it doesn't cost the company as much to raise capital through the issue of bonds because these interest payments, these coupon payments, are tax deductible. In reality, after tax cost of debt after tax is this annual yield that we've just calculated multiplied by 1 minus the tax rate that is applicable to the companies. Let's just assume that the tax rate is 30%, in which case the after-tax cost of debt for the company is going to be 2.32%. Next, let's move on to the next source of capital, preferred shares. The company can issue and sell those newly issued preferred shares, hence raising capital as well. Preferred shares generally pay a fixed dividend. Let's say a share pays $10 in fixed annual dividends. And if the share is traded on the market for the price of, let's say, $160, then presumably the newly issued shares can also be sold on the market for this price. Let's just for now ignore any slippage and price changes due to bringing a greater supply of these newly issued preferred shares to the market. So the cost of raising capital in this way is basically the yield again that the company generates to the holders of these shares. And the yield in this case is very easy to calculate. If an investor buys the preferred shares for $160, which pay an annual dividend of $10, the yield is simply 10 divided by 160. which is 6.25% per year. Alternatively, perhaps the dividends are paid quarterly rather than annually. Or perhaps there are monthly dividends or semi-annual dividends. Whatever is the case, let's have a look at one alternative example. Let's say we have $3 in fixed quarterly dividends, and the share price on the market is $180. We simply convert the cash flow generated by the company to the shareholders into the annual yield. Per year, the shareholders will receive $12, and as a percentage of buying the share for $180, that generates 6.2%. And this is how we calculate the cost of capital raised through issuing preferred shares. Finally, let's have a look at the third source of raising capital. That's issuing and selling those newly issued shares. But basically, again, what we look for is the yield generated by the company to those shareholders. In case of common shares, in case of equity, we have a couple of formulas that might help us to find the yield generated to the shareholders. And those are the formulas from the dividend growth model and the capital asset pricing model. So what do these models tell us? The dividend growth model helps us to calculate a more or less fair stock price by looking at the ratio of next annual dividends, the dividends per annum, the ratio of that to the difference between the minimum required rate of return on investing into this stock and the expected growth rate of those dividends. What we can do with this formula is just rearrange it to find the required rate of return that the investors basically would require in order to be enticed to buy the newly issued shares, hence letting the company to raise capital. Alternatively, we could have a look at the capital asset pricing model, which tells us that the required rate of return is equal to the risk-free rate of return. The investors would at least require that, even if there was no risk of investing, plus the payment per unit of risk, that is a risk premium on the market, times beta, which is a measurement of the amount of risk associated with the company. And to clarify here, the market risk premium is the difference between the expected market return and the risk-free rate of return. Next, let's throw in some numbers. Let's say we have shares traded on the market for the price of $280, and let's say the most recent annual dividend per annum was $8. Say the dividends are expected to grow by 4% per year, and the company beta is 1.2. Say the risk-free rate of return, perhaps the return on short-term government bonds is 2%, and the expected market rate of return is, let's say, only 6.3%. We can calculate the cost of equity using these formulas according to the dividend growth model and the capital asset pricing model. According to the dividend growth model, if you rearrange the formula to find the required rate of return, you will see that it's equal to the next dividend, which is the current dividend multiplied by 1 plus the expected annual growth of dividends, divided by the price, and plus, again, we have the expected dividend growth rate. All of that gives us 6.97% as the required rate of return, or the cost of capital to the company if the company raises the capital by issuing new shares. That is according to the dividend growth model. According to the capital asset pricing model, the cost of equity is that risk-free rate of return plus the risk premium, which is the difference between the market expectation or the market return and the risk-free rate of return, and all of that multiplied by company beta. That gives us the cost of equity of 7.16%. That is somewhat different from the calculations based on the dividend growth model, which is quite normal. Different models might give us different results as long as they don't differ wildly. So what we could do here is just take a simple average of these two numbers. Take the average of these two, and we get 7.07% as the cost of equity. And now that we've finally seen how to calculate the cost of equity, cost of preferred shares, and cost of debt after tax, we can combine all of them into the weighted average cost of capital. So with other numbers for this example, let's say the cost of equity, cost of common shares is 8.5%, cost of preferred shares is, let's say, 5.8%, and let's say after tax cost of debt is 4.2%. What we also need is the capital structure in relation to these three different sources of capital. For that, we can use the prices of the common shares, preferred shares, and bond prices, as well as the numbers of those outstanding. So let's say the share price is $280, preferred share price is $180, and the bond price is $1,100. Let's say the shares outstanding is 120 million, preferred shares outstanding is 20 million, and there are 10 million shares of bonds outstanding. So percentage of capital within each of these out of the total will be our weights for the weighted average cost of capital. So let's calculate these things in millions. That would be 120 multiplied by the share price, 20 million multiplied by the preferred share price, and 10 million bonds issued multiplied by the bond price. In total, we have the 48.2 billion. And to look at the capital structure, we look at percentages of each of these three sources of capital, percentages of capital structure from each of these three sources divided by the total. Fix the reference and copy the formula. These are going to be our weights: the weight of equity in the capital structure, the weight of preferred stocks in the capital structure, and the weight of debt in the capital structure. So lastly, to find the weighted average cost of capital, that's simply the sum of the products of the weights times their corresponding cost of capital. So the weight of equity in the capital structure multiplied by the cost of equity plus the weight of preferred stocks in the capital structure multiplied by the cost of preferred stocks, and the weight of debt in the capital structure multiplied by the cost of debt after tax. Now let's plug in the numbers into the formula. We have the cost of capital from different sources over here and their weights over here. That gives me a weighted average cost of capital of 7.32%. And that is how we calculate the weighted average cost of capital. Let me know what you think in the comments below, and have a nice day.